Hey everyone, this is Ken Klippenstein with Breaking Point's Intercept edition. I'm joined today by Professor J.W. Mason, an economics professor at the City University of New York. I'm going to be talking to you about what the Fed has forecast as a forthcoming recession, what the stakes are for labor unions and for ordinary people that have to live off of their weekly wages, such as myself. It's really scary to see that the Fed has just accepted that there's going to be an increase in unemployment, and indeed is engineering that as part of their plan to bring down inflation. And I'm having the professor on to talk about what exactly that means, that trade-off, because you're only really hearing about the inflation half. There's not a lot of willingness to speak candidly about the effect on employment, the labor market, and what that could mean for organized labor. Professor.
Well, as you say, everybody is sort of obsessed with inflation right now, and the Fed certainly is talking about nothing but inflation. But there's a lot of other stuff going on in the world besides inflation. It's not the only thing happening right now. And one of the other things very important that's happening is in the labor market, where we are seeing a labor market that in many ways is more favorable to workers than we've probably seen in our lifetimes. If you are perhaps a young person, or any young people coming out of college, going into the labor market for their first time and looking for a job, it's a very different experience than for most of us. Historically, it's much, much easier to find a job right now. And that, of course, applies to people who often have the hardest time finding work, young people, people without college degrees, people who are disadvantaged in other ways. But it also means for anybody, if you're not happy with your job, you have a much better chance of just saying, I'm leaving, I'm going somewhere else. There's other people who will, treat me better for my work. And if you're an employer, you can't just, say, I don't care, I'll replace you tomorrow, I'll fire you if you don't do what I say. And there's a lot of things that happen as a result of that. We're seeing a growth of the union movement that we haven't seen in a long time, or at least some successes in organizing in companies like Amazon and retailers and food service, fast food restaurants. If you go back to the 40s and 50s, there were a lot of union jobs in retail and food service. But in most of our lifetimes, the labor movement has never made any headway there. And the fact that's happening now, there's a lot of reasons for that, but one reason is certainly this very tight labor market. And, that's obviously good news if you're somebody who, works for a living or you're on the side of workers. But it also has a lot of economic significance, because it means that businesses, that can be more productive, that can get more value out of an hour's work, can afford to pay more for it, and they can pay more and they can attract more workers. And businesses maybe that were able to survive in an environment of very cheap and abundant labor, and so they didn't pay much, they didn't produce much, but it was okay because they had lots of cheap labor. Those businesses can't necessarily succeed in the kind of labor market that we're seeing today. And that's actually, it obviously you're mad about it if you're one of those employers who always took it for granted. You could get all the cheap workers you wanted, and they'd do whatever you told them to because they were scared of losing that job. So if that's you're probably pretty mad right now. But for the economy as a whole, that's a big way that progress happens. Productivity grows. In part, of course, we have new, scientific discoveries. We're learning to make better solar panels and windmills every day, and that's great. But it also just happens when businesses that are more productive displace ones that are less productive. A business, that just depends on cheap labor to produce something that's not very valuable is not going to survive in an environment where labor becomes more expensive. It's harder to hire people. And that's actually a very positive thing for the economy as a whole. And I think, we also, are finding, I think on our way to finding new ways to manage the workplace that aren't so much based on fear and domination by the boss, and are more perhaps, give workers a little more of a voice. And in the long run, again, I think that's really very, very positive for all of us. But that can only happen if if this tight labor market continues. And the danger now is because we've got this sort of inflation monomania. We've got this idea that nothing matters except whether this price index, the CPI, comes out 2 or 4 or 6 or 8%. Well, if you step back and you say, wait, why is this so consequential? It might be hard to actually figure out why, but we've somehow got ourselves convinced that that is the only thing that matters, and we're going to sacrifice everything else, including these really positive developments on the altar of low inflation.
Yeah, that's something that's really puzzling to me, is not that we're talking about inflation. Of course, the price of goods, matters to ordinary, everyday people, but that we're divorcing that from the labor context that you're describing, from the wage context. You have to compare any sort of inflation you're seeing with the extent to which wages are improving. Isn't that the only sensible way to look at what conditions are like for any
Right.
sort of ordinary person.
I
And they
mean,
don't do
that's
that. It's
well,
just
that's
looking at the
true.
prices.
But it's not even just wages, because you can be better off in other ways. People
Right.
carry a lot of debt. Most Americans have quite a bit of debt. If your wages go up and the prices of the stuff you buy goes up, you might say, oh, you're no better off. But you are better off because the amount that you owe didn't go up. And so you're actually, that debt is less burdensome to you. The relatively high increase in prices and wages, both that we're seeing today, certainly one silver lining that has is it makes the debt that people are carrying less of a burden. It's also the case, as I said, that with your work, your wages are very important, but it's also important, what kind of conditions you work under. The fact that people have the option of working from home today, that's a big improvement for a lot of people in their lives. We had all
Right.
that unpaid time of commuting back and forth and so on. And the fact that people can actually, bosses say we want you back in the office, but people can say, well, I don't really want to do that, and they, they can't really make it stick, and that's a function of these tight labor markets, and that's a way that people are better off, even if it doesn't show up in our
Right.
sort of real
And
wage statistics.
that's a really important point you touch on in your piece, which is that there's all of this discussion is what if the expectations of inflation become fixed and people expect inflate that this is the new reality. Now, I'm not saying that's not an important part of the story, but that's only half of the story. The other part of it is what if employers begin to think that the tight labor market conditions, so-called, are the new reality? They might actually be incentivized to try to retain employees, and that benefits everyone because we just have a more sane working environment that people can want to stay at and advance through, as opposed to the insane churn and burn that we have in virtually every industry now. Can you talk about that a little bit? How
Yeah,
employers'
that's
expectations might
absolutely
change?
right. It's this weird thing where we talk about, inflation expectations. Well, sure, people may have expectations about inflation. They have expectations about a lot of other things too that
Right.
may be relatively fixed or change. And I feel like some of these inflation hawks, which unfortunately today includes a pretty wide swath of the political landscape, these people who feel get inflation down at all costs, they have surprisingly little belief in markets. I mean, anybody who knows me knows I am not a great advocate for the free market, or but I do think that businesses in general try to pursue profits and look for lower cost ways of doing things and respond to the conditions that they find themselves in. I think businesses do have the ability to adjust in a sort of rational way. And businesses, that find themselves short on capacity or find themselves dealing with higher labor costs, they're not necessarily just going to sit there and throw up their hands and say, oh, well, nothing we can do about this. I guess we'll just raise our prices. They're going to say, let's look for ways. If labor is expensive, let's look for ways of doing more with less labor. When the minimum wage goes up, everybody says, oh, my God, they're going to replace all those fast food workers with kiosks. But in an environment today, like where we're supposedly dealing with a labor shortage, that would be a good thing. Get people out of the fast food restaurants. Let them do something more productive and meaningful with their days. That would be a good outcome. And if labor is scarce, that's an outcome we will see, and it's fine. We're going to see other types of adjustment by businesses, again, if they think these conditions will continue. We're going to see investment. One of the real problems we have now is that after the Great Recession, a lot of businesses cut back on investment, they cut back on capital spending, and so they didn't have the capacity to respond to the surge in demand we've seen more recently. Even if you go back just to the beginning of the pandemic, a big story there is that the auto companies said, oh, well, nobody's going to be buying cars for years. We don't know what's going to happen. It could be another, recession, depression. So they canceled all their chip orders and they scaled back their production plans. And then come to find out, for once, we actually handled an economic crisis well in this country and maintained people's incomes. And people actually had plenty of money to spend. In fact, they had more money to spend on cars because they weren't, going out to eat or going on vacation. And the auto companies were caught completely flat-footed. And these, the chips and other inputs, you have to source them well in advance of producing the car. These are
Right.
very specialized. So the result of that is a scarcity of cars and a rise in price in cars. And we say, oh my God, inflation. But we have to be clear, the reason we're having that inflation is not because people are spending too much money now. It's because these companies were too pessimistic a year or two ago. And the solution to that is not to say, oh, well, I guess we have to make their gloomy forecast a reality. The solution to that is to keep the boom going long enough that businesses can adjust their expectations, say we're going to face strong demand, and we need to boost our capacity so we can actually produce enough cars to meet people's desire to buy cars.
So moving back to the Fed for a second, a point you raised earlier which I think is a really important one, is that the sort of unprecedented in recent times, at least, labor ferment that we're seeing right now, the unionization efforts, the demand by workers for better conditions, is in part contingent on the economic landscape that we have, which the Fed is just, to my mind, going to destroy with these interest rate hikes. To what extent is that being factored in when business is pushing for these changes? Because as you said before, I can't imagine they're very excited about the state of the labor movement right now. And how seriously are these interest rate hikes going to have an effect? Just the ones that they've put in now, not even speaking of the ones they're talking about putting in place next year.
Well, I think that the silver lining, maybe the grounds for being a little optimistic here, is that the Fed, when it comes to the real economy, when it comes to the labor market, the Fed is not as powerful as people sometimes imagine. The Fed is extremely powerful when it comes to financial markets. If the Fed were to pick some financial asset in the economy, whether it's, mortgage-backed securities or Bitcoin or a 10-year treasury bond or whatever it is, and they say, we think the price of this thing should be X, the price of that thing is going to be X. When it comes to financial markets, they're pretty close to the God of the Old Testament, let there be light and there was light. But when it comes to the real world, they're not always that powerful. The ability to change the price of a financial asset actually does not give you the power to dictate hiring decisions by business or spending decisions by households. And there's a lot of tailwinds right now. And, households came out of the pandemic with very strong financial conditions in a lot of cases. A lot of people really built up their savings, paid down debt, and that creates some headwind, tailwind. And businesses, are seeing strong demand, which is the biggest factor in investment. So I think, if you could imagine if the Fed somehow, saw the light and stopped hiking rates today, you could imagine that perhaps what they've done so far would not have much of an impact. The rate hikes so far are pretty much equal to what we saw in the last tightening round, 2015 to 18 roughly.
Right.
And it's very hard, if you look back at the statistics on growth and employment for that period, it's very hard to see much of an impact there. So now I think you're absolutely right. Unfortunately, if they continue hiking aggressively enough, long enough, they will set off a recession, a downturn.
My concern is the rapidity with which they're pursuing this. I did a story recently on a Fed research report they put out warning not necessarily that the hikes in total are huge, but that they're pursuing it too quickly. And the idea is that there's a lag time between when the Fed introduces a rate hike and when the effects on the economy register. And it seems like they are just going boom, 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 pursuing this stuff as quickly as possible. And it's like, I heed the Fed's own warning. It's kind of interesting to me that their own research is warning these things. The IMF and the World Bank put out similar warnings last week about not necessarily rate hikes in themselves, but how quickly, and also the multiplier effect that all of these different central banks internationally pursuing this program at the same time can have, and one which can't be anticipated until you've sort of seen the effects down the road.
Yeah, that's right. If you look at the Fed's own sort of basic macroeconomic model, they say it's about 2 years, between a change in the federal fund rate or the policy interest rate, and its sort of maximum effect on GDP and employment. So the rate hikes that are happening now, might have their strongest effect in, towards the end of 2024. Wow. And we really don't know what economic conditions are going to look like at that point. It's very possible that at that point we'll be saying actually inflation is too low, or it's very possible we'll be saying, unemployment has gone way up and we're in a recession and we need more demand. So this is one of the reasons why this is not a very good tool to try to sort of precisely steer the economy, because
they call it a blunt instrument.
Yeah, it's a blunt instrument.
It's not a scalpel. It's just bringing down the sledgehammer.
Yeah, that's right. And it's also, there's this big lag. So, if you're steering a big ship and the time between when you turn the wheel and the time the actual vehicle turns, there's going to be a big delay. You don't want to try to make sharp turns in those circumstances. Right. You want to be very cautious, make sure you see the results of what you've already done before you, and they are definitely not following that principle right now. I mean, who knows what's going on there, but it certainly seems like they've gotten a little panicked. They've gotten spooked. Maybe Jay Powell, who was very much on the sort of Dove side not so long ago, and was talking about the importance of pursuing full employment. Maybe he
And
feels like he's got to now be twice as tough to sort of compensate for his softness, a year ago. I don't know, but you're certainly right that most people who study this stuff would say you need to be move slowly because your tool does not, you don't get feedback in real time.
right. And one other thing, what would be a more constructive response to inflation? Because again and again, particularly in the sort of mainstream financial press like CNBC, you'll see them say, well, okay, so, the Fed might trigger a recession, but we got to do something about this inflation. And that to me strikes me as disingenuous because that's completely ignoring the potential for, a fiscal response, or at least pressuring for a fiscal response, or maybe even, a more targeted set of policies by the Fed. What would be a more sensible reaction to
Right.
the
Well, the
inflation?
first thing we have to say is we have to get out of this mindset. We must do something. Look, nobody wants 8% inflation. But if you try to figure out what are the costs of 8% inflation, what is the actual bad thing that happens when inflation is 8% rather than 4% or 2%, it's very, very hard. We know when inflation gets up to 50 or 100% a year, there's going to be very clear effects on growth. A lot of types of forward-looking economic activity are very hard to do. It's hard to even budget in a rational way when inflation is 50 or 100% a year. But if we're looking at single-digit inflation, there's people have done an enormous number of studies on this. It's very hard to see the costs in a consistent way. So the first thing we have to do is get out of our heads that this is a crisis and we must do something. It is a problem and we would like to do something, but there's other problems in the world. And it's not obvious that if we had, 2% inflation and 8% unemployment, we would be better off. In fact, I would argue pretty strenuously in that scenario, we would be worse
Right.
off. So
Yeah, explain to me this.
There has to be a weighing of costs and benefits here, and not just this absolute, we must bring inflation down no matter what.
Why is it seen as acceptable to trade inflation for unemployment? I mean, if I'm a worker, I'd rather have goods that are 5 or 10% more expensive and have a job. To me, not having a job seems worse than having slightly more expensive goods.
Right.
So
well,
why does that find no expression in the media
Obviously,
ecosystem?
it's about who's making policy. The people, your Larry Summers or Jason Furman or Jay Powell or all their cheerleaders, they're not the ones who are going to be losing their jobs. They're not the ones who are going to be evicted from their houses. They're not the ones whose kids are going to be going to bed hungry. So, it's very easy to inflict those costs on somebody else, whereas inflation, everybody is paying that. I think there's deeper reasons too. It's about, I think some people actually don't like a tight labor market. They like it when labor is scared and kind of compliant. But let me go back to the question you asked before, which is what else could we be doing instead? Because I think it's a really important question. And I think the way we have to answer that question is to stop talking about inflation in the abstract and talk about specific prices, because there's a lot of different things going on behind that. So if you talk about energy prices, which is a big part of the overall picture, and I think a bigger part than the statistics tell us, because that's an input into almost everything else. I saw a study recently that I thought was pretty well done that argued that the overall impact of inflation on the price level is about double the direct impact. So look, energy prices are set in global markets. There's nothing the Fed can do in terms of the U.S. economy. The Fed is a little bit the central bank of the world. Maybe they can trigger a global downturn. Okay, but certainly nothing that's happening like in U.S. labor markets has much to do with energy prices. What we need to do, first of all, is we need to de-link from global energy markets, which we can do, fortunately, by doing something else we really need to do, which is move towards much more sustainable energy. To the extent that we're, depending on fossil fuel and wind power and solar power and so on, we're going to be less vulnerable to these swings in global fossil fuel prices. We need to, address somehow the instability that drives a lot of these global swings. And in the short run, we just need to send people checks to compensate them, But that's one set of problems. Housing is a different set of problems. Housing prices are going up a lot, and that's a real source of hardship for people. But it's not a new problem. If you look at the last couple of years, I was just looking at this, in Los Angeles over the last couple of years, housing rents, market rents have gone up by about 6.8% a year, a little under 7% a year. That's a lot. But if we go back to the years before the pandemic, rents in LA were going up about 4.5% a year, which is also a lot.
Yeah, and suddenly it's
not a new problem. It is a long-standing problem. We need to boost housing supply. We need land use reform. Some people on the left don't want to talk about that, but we need actually to allow the market for-profit developers to build more high-density housing, but we also need social housing. We need a lot more public money, and we need rent regulation, at least in the short term. So that's a problem that is not really, it's a very important problem, but you're not really understanding it if you just stick it in a box labeled inflation. And then, we have education, healthcare, which are areas where there's already huge government involvement, and there it's really possible to use the leverage the government already has to influence price setting, which we're getting, a smidgen of, with the IRA, the Inflation Reduction Act, with Medicare negotiating over drug prices, but we can do a lot more using those levers. But again, it's not really an inflation problem; it is a healthcare and education prices problem. And then, we have ongoing supply chain problems for manufactured goods. And some of the solution there is we need to really invest in our port infrastructure and our transportation infrastructure, and maybe think about onshoring some of these key components that we're dependent on imports for. But also, frankly, that's an area where I think there is an argument for letting the market work. The chip manufacturers are not holding back supply to boost prices. They would like to be selling more chips. The auto manufacturers would like to be selling more cars, and if we give them time and don't, crush demand with excessive interest rate hikes, they will figure out how to solve these problems. So I think you really have to get away from the notion that there's a one-size-fits-all solution to rising prices.
Yeah, I think that's a really important point, because when you see the sort of discourse on cable news about these things, it tends to be an across-the-board treatment of things, whether it's inflation or labor conditions, because there are subsets within, as you said, there's different price rates for different things, and even within the labor market. If you look at, say, the data it suggests that people in the hospitality industry, the lower working class, are doing a lot better than other segments. And so to make these sweeping proclamations about inflation and workers, and without talking about, well, who do you mean? What do you mean? Seems not just irresponsible, it's sort of disingenuous, because it feels as though they're trying to trigger a sort of panic, and not that we don't have problems that we need to solve, but trying to make people think that they're all in precisely the same boat, as you said, as Jason Furman and as all these other multi-million-dollar economists, whose interests couldn't be any more different than anyone else's, acting like, oh, we're all in this, we've got to tighten our belts, and we're going to have to accept a lower living standard. It's like, well, that's not going to affect you at all, And I wish they would be a little bit more candid about these things.
Yeah, you're right. I mean, this has been a great labor market for people who normally do not experience a great labor market, for people with low wages, less education, non-white people, young people. Those are the people who are really benefiting from the current tight labor market. And I think we should be more candid about, when you say, those are the people I want to bear the costs for, my belief that inflation ought to be lower. I think there's not a lot of honesty about that right now.
All right, Professor, I'm very grateful for your joining me and for sharing your insights.
Thank you for having me.
All right, thanks everyone for joining us as well. This is another edition of Breaking Point's Intercept edition.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.